Milind Karmarkar of Dalal Broacha Fund Managers joins us right now on the show. Milind, so good having you. Thanks much for taking the time out, and hope all is well with the family and business and colleagues.
Yes, I hope everything is well with you all too.
Touch wood, Milind, so far so good. I'm believing though, Milind, and I want to start off with a narrow pocket and then we'll get to the broader pocket of investing for the markets at large.
Okay.
But just wondering, because you look at consumers so closely, Milind, and the epicenter of this problem seems to be the demand destruction, right? It is gone for now, and one doesn't know when it comes back. How do you navigate consumption and consumption-related names in such a scenario then?
So it's very simple. At the prices at which they have gone to, you just sit tight because, I mean, we have seen wars earlier. We have seen not exactly pandemics, but yes, we have seen disease having their impact. For example, 2009-10, I was just going through certain statistics yesterday, and India had lost about 2,800 lives in a span of about 6-7 months that time. But probably it was not so taken up by the media, or of course, this is not demeaning what we are going through right now. But I'm sure the demand bounces back though. So, but of course, next 3 to 6 months are going to be bad for these companies.
So, Milind, your point is well taken that sit tight because the prices, the damage that should have been done is already, I mean, the point of selling is probably past us. My question is whether it is too soon to even consider going out and buying into consumers, not staples really, but discretionary, or consumer financing as well, because we're seeing this clear damage in all of those consumer financiers as well, with the bluest of blue chips names like Bajaj Finance also falling by the wayside right now. What do you do there? Do you just sit on the sidelines for the time being?
So it's like this, that price action is one, and the second is, of course, how the company is likely to do going forward. So I would look at those names where the balance sheet is extremely strong, because you will need a very strong balance sheet to navigate through difficult times. So yes, consumer names where balance sheet is very strong, I wouldn't mind starting to accumulate as of now, because 3 to 6 months is not a very long period when it comes to investing for long term. So that I would suggest people to start accumulating now, but it has to be let's say a very, very slow process.
Milind, the other bit is, we read so many articles during the last few days, Milind, and I think a lot of people are wondering if the very nature of how some of the businesses which thrive on crowds coming together and operating, multiplexes, malls, retail chains, the likes of DMart or Trend or Shoppers Stop, etc., would do in light of how scared the consumer would be about possible infections, not now, but over the course of the next 6 to 9 odd months, maybe. How do you navigate that piece? The balance sheet for some of these might be strong, but the business case might have gotten altered, if not for good, then at least for the next 9 months.
So let me put it this way, that, looking at long-term investing, I think 9 months is not a very long period. That is one. Second is that history always teaches us a lot of lessons. So if you go back to 2009, where US was significantly impacted by a virus which was H1N1, probably the elder brother or a younger brother, whatever you call, of the COVID-19. And it is estimated at that point in time about 15% of the US population was affected. And despite that, within 9 months or 1 year, US bounced back. In fact, there were retail chains like TJ Maxx and a few others which did very well going forward. So I have not seen this impacting over a longer period of time, but shorter period of time, yes, there will be scares, so people will be cautious. So yes, you will have to live with that.
Okay, so Milind, now markets have tended in the past at times to discount all of the damage in a go. Like we saw that in 2001, I think. Maybe we did see it in 2008 because it was a long protracted fall. But currently too, the markets have dropped like a stone. Do you reckon that, in your estimate, of course, and these estimates could vary, it could change in 1 month's time and all of that, but as things stand, Do you think the markets are baking in a larger piece of the earnings damage that will come in for a set of companies, if not the market at large?
So I was looking at a few companies and which were trading at multiples of 50 plus for FY22, now trading at a multiple of 25 plus. And if these companies continue to grow at say 25-30%, barring the 6 months which we are from now onward, so till September, I think you'll have to give it a pass. But beyond that, if they continue, if they are capable of growing at 25-30%, then I think this is the time. Probably they have bottomed out, but again, markets are all about greed and fear. So if tomorrow fear takes over significantly, then the markets could go down further. So no, basically, it's very difficult to take a call on the markets. But as I said, that good quality stocks, if in individual perception they have fallen at a reasonable level, this is the time to start nibbling on these stocks.
Okay, so Milind, tell me. I would want to know. I think a lot of our viewers would want to know. When you're looking at, let's say you're looking at accumulating some businesses, because you mentioned that you're looking at names. What do you look at? Do you look at a normalized year of functioning for a business, and therefore you discount FY21 completely, and then look at what possible earnings in FY22, FY23 would be, and then try and assign multiples that way and give a bit of a discount? How are you, when you are assessing the fundamentals of a business, how are you going about deciding that, okay, this is the right parameter to approach and let me buy it because it has hit that particular parameter?
Right. So there are 2-3 things which I look at. One is that while looking at any business, what is crucial is looking at the long-term growth prospect. So in the shorter term, as we discussed, that say 6 to 9 months, anything can happen. But over the longer period of time, as long as you are comfortable at the rate at which India will grow and at the rate at which per capita income is likely to grow, then with that as background, if you look at individual businesses and estimate as to how fast or how long they can grow at a very reasonable rate, which you can give them, then discount the cash flow, and then there would be many businesses which you could buy at these levels.
Okay. Milind, the other bit is how do you approach financials? Now, I don't quite remember what your stance was earlier, but what is your stance now? Because there could be disruptions that will come in, asset quality issues, which nobody quite knows. I mean, if you hear Aditya Puri on the con call, he seems fairly confident about the nature of the borrowers that HDFC Bank has, for example, and how the asset quality issues would be minimal. But multiple brokerages have had very different and staggering opinions here. What is your opinion? And therefore, how do you approach some of the large quality financials?
So again, here you have to look at these companies on a going concern basis. So if you look at them as a going concern, then you will of course have to factor in the short-term movements, short-term impact that some of these issues will have. Like it's possible that in retail there could be a delay of a few weeks in payment of EMIs. But again, most of the companies are trying to continue to pay their employees, and if that continues to happen, then I don't see any major impact over a longer period. Shorter period, yes, there could be an impact. Frankly, if this prolongs beyond 15th of May, then I think there could be an impact in the shorter term on the fundamentals of these, especially retail-focused finance companies. And that is the reason why finance could be a bit tricky. Finance as a whole segment could be a bit tricky, but I think we'll have to live with it. And at a price, say one-time book, or if you're getting something close to, say, even 1.5-time book, it may be worth looking at after, because when I'm saying 1.5 or one-time book, this is after discounting the expected NPS that the company can generate. I think then it's a reasonable, it would be reasonable to start buying these companies as well.
Milind, a couple of final questions really. One, so therefore, what's your sense? Is the market discounting all the pain, and would you be looking at market-wide valuations at the current levels, or are you restricting it to a couple of specific pockets right now?
So as I said, your guess is as good as mine in this case. But as I said that I would suggest people to start nibbling into the market at the current juncture. It's not saying that the market may not go down. It's possible that the market may go down further because it all depends on how this virus goes ahead. But let me tell you one thing. So I was going through a CDC video just a couple of days back, and what it said was that this was during 2009 pandemic of H1N1, and the US was able to find a vaccine within 7 months' time. At that point in time, we are already 3 months into it, and say maybe 4 more months, and we should be able to get a vaccine on that. Because ultimately, it's a protein, it's not a living being. So finding a vaccine may not be so difficult. The only time which will be required is probably for testing. So once that happens, I think within next 6 months' time, we will have a possible cure. Viruses will keep on mutating, and probably every 7-8 years, we will have to assume that we will have this kind of a issue globally, because I've been seeing, at least for out of last 20 years, this is the second or third time that we are having it. So I think we will have to continue living with this, and but I think I'm quite positive that ultimately science will win, and we will be able to have a vaccine, and then hopefully everyone will live happily ever after.
Well, inshallah, as they say. Milind, one final question. So what's the top, within the space, I'm not asking you for what you're buying. I'm asking that what looks the best from a valuation risk reward standoff currently. You may choose to buy it full hog right now. You may choose to buy it over a staggered period of time once all of this subsides. But what are the ponds in which you are fishing?
So it's very clear that consumption is what I think will return, and will return fast. So whether it's discretionary or non-discretionary probably will come up first before discretionary comes in. And then, of course, retail-centric banks will continue to do well. It's a question of time. I think this fear which is created by COVID has given you opportunities, because many companies in these two segments have come down considerably. And probably this is an opportunity to buy.
Okay, Milind Karmarkar, we'll leave it at that. Thank you so much for taking the time out and being with us and giving us your thoughts. Appreciate your time, and stay safe.
Thank you. Thank you so much, and stay safe, all of you. Thank you.